we're optimistic on 2026. We see it as a continuation of the current backdrop where there are both headwinds and tailwinds, but where the tailwinds will ultimately prevail. At a cyclical level, this includes a consumer underpinned by healthy balance sheets and strong wealth effects, easy credit conditions and low policy rates. At a structural level, this includes the AI thematic, which is still in its early stages. There are imbalances in many developed economies, such as record levels of AI capex against weakening labour markets and elevated inflation. But we don't see these imbalances as changing the narrative for 2026, where policy rates will fall further, where tech investment continues, and where the consumer remains solid, even if unbalanced. Finally, we think we're about 80% through the global rate cut cycle, following around 175 to 200 basis points of cuts across developed economies. While further cuts will be modest, policy lags mean the benefits from prior rate cuts are still to come for many economies. With the Fed likely to underpin sentiment at least for some time to come, while growth is not likely to hit escape velocity in 2026, it's solid enough to support another year of equity market gains. For Australia, the macro backdrop looks solid, but there's a dichotomy between macro numbers and how the average Australian will feel in 2026. Growth will consolidate around trend before picking up towards year end. On the bright side, investment is booming, driven by tech spending on data centres. Housing construction is recovering and wealth effects are strong. In addition, the labour market remains tight, albeit loosening at the margin. However, this comes against uncomfortably high inflation readings that have removed expectations of further rate cuts by the RBA in 2026. We don't believe the economy is firing on all cylinders. Instead, we think this is an economy that is constrained by structural problems due to policy inaction. This means economic imbalances will have a bigger impact in Australia than in other developed economies where central banks are still in an easing phase. The last mile of the inflation fight was always going to be difficult, but the RBA did not get in front of this, and the consequence is that rates will bottom at much higher than normal levels, and after 75 basis points of cuts, we are now at risk of rates moving higher. This is a picture where the outlook is solid, where growth improves but where the gains are modest and where the cycle is constrained. Unfortunately, it will feel a lot better for some than for others.